times via email and live chat and everything.
I love it. You guys are some of my favorite people as well, so the feeling is mutual.
Fantastic. Well, I'd like to welcome everyone to our fourth StartSmart Webinar series. They've been my highlight of every week. And today we have Mike, the CEO and co-founder of Visible, and Marie, the managing partner of Flat6Labs Cairo. Both of them are experts on metrics, KPIs, investors, how to communicate with investors, how to present the proper information. And the agenda for today is where Marie and Mike are going to have a conversation. Mike has a presentation to share with everyone. And in 30 minutes, 35 minutes, we'll start taking questions from the attendees. You can send in the Q&A box, or you can put them in the YouTube comments if you're on YouTube, and hopefully we'll get to as many questions as we can. I'll leave the floor to Marie to get the conversation started.
Thank you, Sarah. Good afternoon, everyone, or good morning, depending on where you are in the world, and welcome to our StartSmart webinar. I'm super excited to be hosting this one specifically with Mike, one of, again, our favorite people at Flat6Labs. We are great advocates of Visible, and it's an amazing tool that we use and our startups have been using. Mike, super excited to have you with us. Just a quick background to everyone about Visible. It was co-founded by Mike when he was part of a venture group in 2014 for actually internal reporting. Correct, Mike?
Yeah, that's exactly right. When we first started to build Visible, I was working with part of a venture group, and we built it as an internal tool, first to solve some of our problems around investor reporting, and then actually ended up spinning it out of a venture group and having it be part of its own company in a way.
Amazing. So you're definitely the expert on reporting and everything that has to do with communicating with different stakeholders. So the big question that we have and the discussion of today is about how to communicate efficiently with all our stakeholders during these unusual times of COVID-19. What is the best way? What are the most important KPIs that investors particularly are looking to see, whether they are existing investors that already invested with a startup, or if the startup is actually trying to reach out to new investors and raise money. Are some KPIs now not obsolete, but less favorable, and no one wants to really see them now? And there are new set of KPIs that are now way more important.
Yeah. Do you want me to start right now getting into that answer? Or?
Let's do it.
Yeah. So, you know, I would say I appreciate you calling me an expert. I feel like I was not an expert 5 years ago when we started this company, but I feel like I at least have a pretty good grasp on some best practices now. And I think the first thing that I've really just come to realize over the past 4 years, especially when it comes to investor communication, whether that's with potential investors or current ones, is just do it. I find that you know, we see a lot of companies just don't do it, and partially that's they don't know how or what to include. And I think there's a psychological mindset as well for the entrepreneur that I'll get into in this workshop little presentation I put together. So I think like just the first thing is just do it. And then particularly right now with COVID and the world, I think more frequent communication is better, right? Because everything is uncertain right now. What was truth 2 or 3 months ago is certainly not true anymore. And I think investors now have more or less given a pass to companies on top line growth. And so maybe metrics around how much are you growing each month or each week, those are maybe not as important right now as the bottom line. How are you managing burn? How are you managing and extending your runway, right? We've gone from this growth mindset to cash has always been king, but it's never been more king than today. So how am I preserving the lifespan of my company and extending runway? Because, you know, right now it's uncertain, so we don't know how long this will last. And so I think metrics have shifted from a growth mindset to how do we make sure we preserve the business in a place that we can get through this and then resume back to growth. Curious, Marie, like what are your thoughts?
Absolutely. I mean, I like the phrase of cash has never been more king than today. That's true. And it's all about building different scenarios because, like you said, we don't know how long this is going to last. And so, in order to estimate the impact on the business, we have to build several scenarios. And this is actually what we've been communicating with our startups. So, would you start and take us through your presentation?
Yeah, absolutely. Let me do this. Let me share my screen. Can you see my screen?
Yes.
Awesome. So really the theme today is just investing in investor communication and some of the things I've learned along the way and best practices. And this is not a pitch to sell you on Visible. This is more a mindset, right? So this is not, hey, you need to use Visible to do this. This is, you can use a lot of different tools to handle investor communication. I think I and Flat6Labs would love you to use Visible, but whatever tool you see best. So we already covered me. I'm Mike Preuss. I'm the founder of Visible. And just a couple things to get started and help set the stage. So Visible, we have a little over 2,500 companies using our product worldwide. So we see this as not just a San Francisco Valley problem, right? Like Visible's actually started outside of the Valley in the Midwest, and we have customers all over the world using Visible in all different stages. But very, I think a common theme is earlier stage startups that have a high growth or want to have a high growth trajectory. And one of the big things that we follow, and a thesis of ours, is if you communicate with your investors on a regular basis or potential ones, you're more likely to have a successful fundraise or future rounds of follow-on funding. And so we track this metric of how much capital has been raised by our customers over the last 12 months on a rolling basis. A year ago, it was 520 million, and now it's up to $1.7 billion. So it's fun because we get to see a lot of different things with our customer base and how the market's changing. The one other thing that I'm really proud of that our company has done is we produce something called the Founders Forward. If you just go to Visible.vc/blog, this is a resource first and foremost for founders. It's completely free, and it's content on our website that we build, as well as a weekly newsletter. So every Thursday, this newsletter goes out in Cairo. That's probably maybe in the middle of your night, so you have it Friday morning in your inbox. But it's what we believe to be the best content on the web that week for operators, for founders, and investors. It's its own brand. It doesn't sell you Visible at all. It's really just meant to be a helpful resource. So definitely make sure to check that out if anything today. And really what we're all about is how do we give startups a better chance at success and help redefine that investor relationship with the startup and the investor. And that's what gets us out of bed every morning and gets us excited with what we're doing. And I think there's three things that we continue to see over and over and over again. One of those is that founders just don't regularly update investors. I think I maybe talked about that. They don't know how to do it, what to include. Maybe they're scared to do it. And then part of that is they don't really know how to leverage their different investors effectively. So, how do I get help? Or maybe I can get an intro to this person, or they can introduce me to a potential hire. And then the last piece that I'm sure everyone can resonate to is fundraising is really, really hard. And it's sometimes soul sucking and just a grind. And so founders really struggle with that. And so really it's how do I improve each part of this, of my psyche and what I'm doing as a founder.
Mike, if I can just interject actually,
please.
One of the observations when it comes to reporting is that some of the startups are very reluctant to report when the numbers are not good. So it actually immediately refers to the point you have here that maybe when the investor sees that you have an issue, they can help. So maybe this is a way to reach out and actually get help. One observation I've had over the years working with the startups that it doesn't always have to be reporting good numbers. Good potentially reports bad numbers. It happens, and there is a reason for it, and you can start working on solving the problem.
Yes, exactly. There's a great story I'll get into shortly that touches on that, Marie. And then I think just to echo that point, investors the one thing investors do very well is they have kind of this mental model or they've seen the movie before and have pattern recognition, right? So they see this over and over and over again. And so if something's not going well and you're sharing that, they're able to jump in and actually help before it metastasizes into like a bigger problem. And so I know it's really scary to share maybe less than stellar numbers, but that's actually exactly when you should be sharing them because it'll help write the business. And I think there's some fun things I'll dive into that that help explain why you should share when things aren't going in the right way. Investors, on the other hand, they lack holistic view of really what's going on across their portfolio, and they want to add insight, and they want to add help, and they want to and be value add. I mean, at the end of the day, the investor is only successful if their portfolio is successful. That is the only thing that gets investors going, and is their success is the underlying portfolio companies. So if you have an investor, they actually really do want to help, and you should be sharing with them because they're only successful if you are. And I think that's one thing to always keep in mind is, if with potential investors and investors, I think the strategies are different, but in the context of your current investors, they really want to add value, provide info, and provide insight. So I'm gonna get into a story here and just some best practices. This is Dharmesh Shah. He's the founder of HubSpot. I love this quote he has, which is, the CEO is the investor's user interface into the business. This is really just a great point in the sense that the investor's lens or view into your business is really through the CEO, and that's it. You're in the business every day. You understand what's going on as the CEO and the founder. And so their only way to get insight or context is through you. And so I always love to tell this story. I think it helps paint a picture. There's two different stories. One is Mark, and one is Sarah. Both startups are going okay. So they both raised a seed fund, both from the same investor, Mark and Sarah. And their KPI growth looks similar, right? It starts out and they jump and they grow, and then it kind of flattens out over time, and they're slowly growing from there. This is probably the trajectory of a lot of startups, certainly Visible's. And meanwhile, your cash balance, you're most likely burning cash every single month, and so your cash balance is going down, both for Mark and Sarah. Mark's cadence when he was updating his investors looks something like this, right? January, hey, we're excited, we just launched. February, hey, we just grew 20%. March, hey, we just grew 50%. And then April came and maybe it was just like not 50%, it was maybe a couple percent. And so Mark was scared, reluctant to share that, and then kind of stops, right? May, June, July, August. October comes around, cash balance, right, is all the way down. And he's like, I need more money. And so he sends out an investor update. Hey, we need more money. On the flip side, Sarah was just very diligent. Every month, same time, same metrics, just producing the same investor update over and over and over and over again. And so Jason Lemkin, the founder of SaaStr, he put this quote out there a couple of years ago. I think it's still more relevant even today, especially today. Not emailing your seed investors until you need a bridge round is very suboptimal, and especially now, right, with COVID and things happening, and a lot of startups are going back to investors and saying, hey, I need more capital. And so who's going to get the bridge in that round? An investor can only make so many choices of where to allocate their reserved capital. They can't put more capital in every single one of their businesses, and it should be a surprise that Sarah is going to get that funding because she's been diligent and the investor knows what's going on with that company every single month. And this goes back to the data set. We've found through our own data and just talking to investors that they're about 300%, so 3x more likely to invest follow-on funding rounds for companies that are providing regular updates. Certainly there's some causation and correlation there, but the point is, if you're proving that you're a great steward of capital and regularly updating investors, that you're more likely to get follow-on funding. I'll hit pause there, Marie, before I continue, but any thoughts or questions you would want to add on there?
Yeah, one thing I believe strongly in is that it's a relationship. So in any relationship, if there's distance, by default, things fall apart. It's not like when you communicate properly with your partner. It's exactly like being in a relationship. So it's definitely super important to maintain the regular reporting. I actually wanted to ask you about the KPIs. Do you think it's about the number of KPIs or about having a real deep thought process about the kind of KPIs that are most suitable to your business? And those are the ones that you should focus on reporting.
Yeah, I think, as it comes to investor reporting, for me, it's the investor update serves as a nurturing tool more than anything. It's how do I stay top of mind? And I think this is both for my current investors and using an investor update with potential investors. What you share in those certainly might be different, but it is very much kind of a nurturing tool. It's like, how do I stay top of mind, right? If you're thinking about an investor at any given time, they are looking at potential investments, they're sourcing new investments, they're supporting current portfolio companies, they're fundraising for their own fund and from their investors. And so your goal is just to stay top of mind with a potential investor or current investor. Because I might have, I don't know, 50 portfolio companies and talking to another 50. And if you're telling me, hey, I need to hire for this person, I'm much more likely to remember exactly what that is. As it relates to KPIs, I think that less is more, actually. I think it's how do I define a set of maybe 3 KPIs that are pertinent to my business. And so, if you're a recurring revenue business, that can be total ARR, churn, and I don't know, net new ARR, for example. If I'm an e-commerce business, maybe that's repeat purchase orders, average order volume, cart abandonment rate, right? I think there's some standard KPIs across all the major different types of businesses or verticals, but I don't think you need to track, everything under the sun. I think investors want to see, do you know what your true north KPIs are? And then how are you tracking and trending over time with those? So I don't think, like I said, I don't think you need a ton, maybe 2 or 3. And I think every business, especially with current investors, the vitals of the business are cash, runway, and burn, right? No matter what business you are or vertical you're in or business model, the vitals of your company are cash, burn, and runway. And so always sharing those with your current investors. I would advocate don't share those with potential ones, right? You don't want to necessarily share that data with potential investors before you have a chance to build a relationship, but certainly sharing those with current ones. I'll get into that a little bit, but what do you think, Marie? Like, I always find that if you're concise and can get a point across with a couple data points, that's better than writing a 3,000 word email with every metric under the sun, because you don't know what's important and what's not. Yeah,
agreed 100%. In fact, you mentioned 3. I think the investor would link your business to one KPI, like you mentioned, and investors have hundreds of companies in their portfolios, but they remember a particular KPI for each of their investee companies. And I think this is the key one. So that's why I think it's very important to have a thought process, like a very thought process of what are the most important KPI or KPIs, 2 or 3 max, like you mentioned, that I need to really report on. So I totally agree with you.
Yeah, I think, for it's like, what is that leading indicator for what will eventually become revenue as like my core KPI? So for Visible, that could be like new qualified trials or total update sent, but like, yes, revenue is every business, but like what is that one KPI that is going to be a leading indicator for what will become a revenue in the future? So, we talked about the story for Mark and Sarah, and I started thinking about, okay, so why do founders behave this way? If we know that investor reporting is good and creates more success and opportunity for a business, why do we still act in this adverse way where we're actually hurting ourselves? And so I started thinking about, and there's plenty of resources, right? Like Visible exists for this reason. If you search investor update on Google, there's a ton of results that'll get produced from those. And I started thinking about it through the lens of a founder and some of the feelings I've had before, where you're reading a local tech blog or TechCrunch, and you're reading about all these companies raising huge rounds of funding and all these new hires and growth. And so you're constantly surrounded in the market by these positive signals of, oh my God, they're killing it or crushing it. The reality is that Mark and Sarah's story is probably the same for 28 or 25 of the 30 portfolio companies of this investor, right? A lot of companies are going well, not great, kind of figuring out their place. And so at any given time, an investor's portfolio has 2 companies that are doing very well. Probably 2 that are struggling really, really bad. And then you have this whole kind of middle ground of companies going good, not great. And meanwhile, your world as a founder is you're just like an isolated, N of one. So you're constantly hearing in the market of all of these things are going well. And so you think that's true for every single company but your own. And so you're less likely to share, open up, be vulnerable, and share things with investors. And so you kind of go in this recluse mode. I think this chart's been shared many times, but you're in this trough of sorrow, right? And so this kind of looks like an update cadence too. You're like, oh, we just launched, this is awesome, and the world's great. And then you fall into this sorrow pit where customers leaving, products delay being shipped, website went down. And so you're not sharing that openly, and you're internalizing all of that and not sharing that outwards. And I think it's important not to think about yourself as a wolf pack of one, but to really take this time to update those investors, stakeholders for their guidance, their input and success. So we touched on this briefly, but just to revisit this point, one thing that investors do well is they have pattern recognition. So they can see and spot something potentially in your business before you can. That could be seeing a misalignment between your sales funnel and price point, right? Maybe you're selling a $100 a month product, but you have a fully staffed sales team doing that. That could be a problem. Or maybe they're seeing you try to sell into the government space, at least here in the States, right? Incredibly slow sales cycle, can take a long time to build pipeline and build decision makers. So investors do really a great job of pattern recognition and can jump in and help. Some other tips. I think just keeping a consistent cadence is really important. And I think this changes and varies by business, but as a rule of thumb, call it, my pre-seed, seed type company, even Series A, I think a monthly cadence is great. A lot changes in a month, but it's still kind of a confined time period where you can share a meaningful update of what's going on. Here are all the changes. Here's what's happened. Quarterly, just too much is happening in an early stage business for a update to be meaningful on a quarterly basis. And so I always default to monthly as a good cadence. Quarterly, I think, starts working well when you're a growth stage company, you have stabilized the business. So call it like Series B plus. And then maybe even earlier on, like when I'm just getting started, I'm going through an accelerator or building out my advisor network, even like weekly updates, like, hey, this is changing, like launching this, doing this, talking to these customers. And so I think the cadence varies by stage. But yeah, Marie, I would love to get your thoughts here because you guys do this all the time. What do you think a good cadence is?
So I agree with you. It really depends on the stage of the company. And obviously at times like these, it's very important, like we mentioned earlier, that to report very frequently because the investor really needs to know what's going on even more closely than before. So I think it largely depends on the stage of the company, but also something else. Do you think it depends on geography in any way? Like, because you deal with companies all over the world. So do you think the reporting frequency has anything to do with where your startup is based, where your investor is based?
Yeah, interesting. I'm sure there's, yes. I don't have any. I'm sure we have data to paint a picture. I don't have any off the top of my head. Do you have a theory? Yeah.
Not really.
Yeah, I'd be curious. It is interesting. At some point, once they have even more companies, I would love to get into geography. It's interesting to see like certain countries even, I think, take investor reporting and relationships more seriously. Like we have a lot of customers in Australia and New Zealand, and for whatever reason, they're very, very consistent with how frequently they're reporting and the quality of those updates. And so it's just interesting to see little things like that. I haven't noticed anything around consistency yet. I just think in general for startups, like monthly is such a good cadence because things might not change super fast on a weekly basis, but quarterly, there's 90 days is a ton. And so I always default back to monthly. I think someone online yesterday, I was actually just looking at it, I think like 84% of companies do monthly reporting. There's like 5% that do weekly, and 10 that are doing quarterly. This is for a seed stage investor. So that data somewhat backs that up.
I think very few industries by default, they function on a quarterly basis. So not much happens sometimes over the quarter, except so you really need to report once. So these are very few industries that maybe have a cyclical nature, and
Yeah.
quarterly reporting would be okay. But then again, it goes back to the point that we spoke about earlier, that it's a relationship. So you need to understand what your investor wants to see. If he wants to see it monthly, even though business is cyclical, then you have to report monthly. It's important to have the conversation and also do what, or report the way the investor likes. So it helps.
Yeah.
Definitely.
I think one of the things that I didn't that's not in this slide deck, that kind of a thesis I'm working through personally with Visible, is we recently surveyed our founder base and found that every founder has pretty much just their top two problems or challenges that they're working through at any given time are sales and fundraising. Yeah. And those are actually the same thing. You're just selling something different. For fundraising, you're selling equity in your company, and for sales, right, you're selling your product or service, but they're actually the same. And if you think about your go-to-market funnel, you probably do something very sophisticated around, or try to, right? You have paid channels and an awareness that you're driving demand for your business. Then you have this middle part of the funnel where someone's evaluating a purchase. Then they purchase that product, become a customer. And then you have like the customer success function, which is like, how do I make sure I retain this person, that they come back, that they tell other people about my company? When you think about fundraising, it's probably not as sophisticated, right? Because these are things that are happening maybe once a year, twice, maybe twice a year, but definitely no more than probably once a year. But the funnel is very much the same. You have awareness, right? You're telling the market constantly things about your company, whether you know it or not. Things on your marketing website, how many people work at your company, how active you are maybe on social channels. Then you have the middle of the pipeline with your investors, which is like, I'm actively now fundraising. Then you have the customer success piece, which is I'm updating my investors. Those are my current investors, right? I'll make sure they're happy because I want to retain them and have them invest in future rounds, because that's a huge signal. If I go to raise my next round of funding and I've already raised capital, the first question any future investor is going to ask is, are your current investors participating? Because if they're not, that's a bad signal, because they've had a front row to the business this entire time. So the point is, I think we tend to try to treat fundraising as this kind of thing in time. But to your point, Marie, it's a relationship, and you need to build those relationships and build those communication channels, because if you don't, you're starting and stopping, and then that's how you get into a 3, 6, 9 month fundraising cycle. Is, well, you are fundraising, but what you're actually doing is building relationships in order to get to a fundraise. And so try to get ahead of that in time. So that was a long-winded way of saying, like, I still come back to monthly as like a great way to build relationships, either with current or potential investors.
Absolutely. I have an actually interesting question that came to mind. So we mentioned that now, in times of a pandemic like we're living in right now, there's a new set of KPIs that startups need to focus on, like burn rate and how they're managing their bottom line and so on. Do you think once this is over and we're back to normal, would they continue to report on the same KPIs? And if no, would this be a warning signal to the investors?
Yeah, that's a good question. I don't know is the initial answer, just because I think this is my first time really living through something like this, at least operating a business. And so, I was just starting my career when the 2008-9 financial crisis happened. So this is kind of my first foray into this. But I think what you'll see, if I had to take a guess, is that a lot of people are going to have recency bias of what's happening. And so I think you will start to see, at least for the next, call it 12 to 24 months, that things like cash burn and just how efficient you are with capital are going to be important for investors. I think they're always going to want to see, right, how are they thinking about managing burn and the bottom line, if I had to guess, right? Because, you know, the past, call it 10 years, it's been growth above all else. And now you're getting in this position where, well, growth above all else usually means high burn. Well, high burn doesn't operate pretty, I mean, there's tons of layoffs happening in all kinds of tech companies of all sizes. And so I think that those KPIs are going to be important, certainly for the foreseeable future. And I think it's always helpful to track them. And if you stop tracking them or sharing them, be deliberate and call out why. And so, hey, we're not going to be sharing XYZ anymore. We think it's not important, but don't like hide it and stop tracking it. I think that's the case for any metric. That's actually my next slide, which is using the same metrics period over period, month over month, year over year. So if you're sharing active users in April, share active users in May and in June and July. Certainly KPIs will change, or you'll figure out maybe that's not the right KPI, call that out and why. But don't just willy-nilly change your KPIs just because, hey, active users was up 30% this month, and then marketing site page views was up 50 this month because active users was flat. Just share the same ones. That'll help just drive better business decisions anyways, because you're like, okay, why was active users down? And you can actually dive into the problem versus trying to cover it up. So I'm not sure if I answered your question, Marie, but I think keeping it consistent, and then if you no longer are sharing something or remove it from an update, just let the investor know why.
I agree.
Let's
So
see.
we have more slides?
I think I'm almost done here, and we can jump into some Q&A. So cash burn and runway, I mentioned this before. These are the vitals of any business, regardless of what type of business you are. It's kind of, are you default alive or default dead? And so having a good grasp under these three metrics, incredibly important. And then again, we haven't really spent a ton of time on this, but the ask section, or how you can help, right, in your investor update, is incredibly important. That's how you're going to get a lot of value and leverage your investor base. And so making it as actionable as possible is super important. So saying something like, we love intros to employees with more than 1,000, or intro to companies with 1,000 employees, that's not very specific, and kind of can get you mixed results, and doesn't put the investor in like context right away. Versus, we love any intros to VPs of marketing at companies with 1,000 employees at North America and CPG. Very specific. You can start yielding results and provide context. Investors are lazy too. Like they are typically pretty lazy and won't go out of the way to do something. And so I think just some fun little tips that I've seen in investor updates before is like creating a LinkedIn. So if I'm looking for a specific role, say full stack engineer, full stack developer, or VP of marketing, go to LinkedIn, type that in my search, copy the URL of that search on LinkedIn, and paste it in as a link. So when an investor clicks that, it opens up their LinkedIn and opens up all the results. Same thing with, like, if you're trying to share a piece of news, whether that's on Twitter or LinkedIn, like a little click to tweet, like, I've already written the tweet for you, like click this, you can make a little change if you want, but I've already written it for you. All you have to do is literally click send. So try to making things as frictionless as possible and as actionable as possible will get you the most results. And then just a couple other interesting things from Visible. Like I said, less is more. If you keep it, monthly and pretty concise, it'll be quick to build and quick to send. And so you don't need a super long form report. We find that most updates share only 4 key metrics, and they're going out to 12 people. So it's not like I'm sending this out to hundreds or thousands of people. I'm sending this out to 12 people is our average, and I'm including maybe four charts in those, or 4 KPIs. So it's not like you need some super extensive, long-winded report. I think my last slide, and then we can do Q&A. So these are some of my favorite benefits of an investor update outside of the kind of tangible ones we mentioned. So for me, it's time to reflect. So much is happening every single day. You can get up and reflect change and evaluate what happened, the previous month or quarter or what have you. What went well, what didn't go well, what do I want to start doing, stop doing, things like that. A lot of times you don't have time to reflect and change. The other big one is it stops inbound requests. Like if you have an investor base, you'll stop hearing them being like, hey, can you provide an update, or can I get this, or what about what's going on? If they know to come on the 10th of every month, I'm going to get my investor update for the previous month, they'll stop bugging you. And then finally, I think it's the really one of the best benefits. It's a sign of an engaged entrepreneur. You're being a good fiduciary of the capital, of the business, and leading things in the right direction. So if you do investor updates right and investor reporting, chances are you're doing a lot of other things right in the business. So kind of just to wrap this all up, like I said to start, just do it. It's, you just send an update. And I think I've been just telling companies this, and the results have been great. I think people are like, I don't have anything to share. I'm like, well, what did you do last week? Well, we launched a new landing page and are testing this on AdWords, for example. Say, well, share that. And so you'll start sharing things, and just like you get feedback from users and customers, you'll get feedback from investors of, hey, I want to see this, or I want to see that, or this is awesome. Can you think about sharing this next time? Keep it consistent, keep it comparable, make it actionable, more likely to get follow-on funding. So those are my recaps. I would love to jump into some Q&A.
Amazing. We've received a lot of very, very interesting questions. So one of the questions that I really like is, what do you think is the biggest mistake a founder can do when communicating with investor? What is like?
Yeah, I think, so let's just say assuming you are communicating with investors. So I think the biggest mistake is companies not doing it. Then if they are doing it, I think the second biggest mistake is making it super long. Make it something that you can read in a minute or two. I think you don't need some long-winded report or update. I think one of the things investors want to see, like, can they clearly and concisely get a point across? And so trying to make it as concise as possible. So I think one of the biggest things is overkill, honestly. Some 2,000 word update that takes forever to read. And then as an investor, you're reading that and you're like, I don't really know what happened. It's like, I don't know what happened, because it feels like you're trying to like cover something up, or maybe not cover it up, but it's just overkill. So I think it's just making it too long.
Yeah. There was a question about actually the challenges of investor communication and how this is further challenged in an Arab or an Egyptian context. So if you don't mind, Mike, I'll take that one. So I think—
Please, yes, because I don't know if I can give a great answer there.
So I think the only difference is that if you are communicating with foreign investors, they may not understand the challenges of your economy or of your market as much as you do. So sometimes when founders talk to investors, they assume that they understand the market and they understand the local challenges, when this is not always the case. So this is something that you have to be mindful of, is to make sure to explain and have the investor understand the real challenges that your product is trying to solve, because it might be a challenge in your country, but it's not in his country or in the surrounding countries. It's not really something that a challenge that exists that needs solving. So this is, I think, the extra bit that needs to be added in a regional context. I hope I answered that. So next one is about the difference between, or how to balance between having to sign an NDA and being completely transparent with the investors.
Yeah, I can speak to NDA here, and I'd be curious to see if this is regional or not. For the most part, NDAs don't matter here in the States. I think it's a potentially, at least in the States, it's a red flag if I am sending an NDA to investors or potential investors.
Okay.
I think everyone, at least what I hear is, if I'm worried about you stealing, it comes down to execution more than anything, right? Your idea might be novel, but for the most part, it really is going to come down to execution and how well you can execute. And so an NDA should not matter. Now, I will say that I'm sure there's things that have heavy IP. Maybe you're building some super deep technology with autonomous driving, or maybe you're solving a cure for the coronavirus, or something that has some deep intellectual property. Maybe an NDA. I would certainly consult with a lawyer at that point, but I don't think an NDA is necessary for an investor pitch or conversation. What do you think, Marie?
I agree, but unfortunately, in our part of the world, sometimes a lot of people ask for it. So I don't know, I find it a bit like worrying, or it's just a bit too much, because at the end of the day, we're looking for a partnership. So starting it off with asking for an NDA can make things a bit like make people a bit nervous. But it's interesting to know that in the US, they are not very popular. So maybe this is a much older ecosystem. Okay, so next we had a question about if the startup should report, it says charity work, but I think they mean any community things they do, things they offer for free and so on.
Yeah, I think it certainly does not hurt. If you have, and especially if it's an integral part of your business, that part of why we exist is to strengthen our community through nonprofit work or volunteering or whatever that is. I certainly think that it's totally acceptable to include that. Now, I have to imagine that most investors are looking for some sort of financial return, so I'm not sure if I would make that the focal point. But if one of your core values and why you exist as a company is for nonprofit, charity, volunteer type work, absolutely include that. Investors want to know what makes you unique and different, and your culture different. So I would certainly include triple bottom line type metrics where those are key to your business.
Okay, I think another interesting question is what not to tell investors in a report. Is there something that I should not report as a founder?
Yeah, interesting question. So I will, and Maria, I would love to get your thought. I'm just going to try to think through this answer here. So I think there's potential investors and investors. I'll start with potential investors. I think for potential investors, and I'm providing a regular update and nurturing these investors, I wouldn't share the vital metrics of your company. I wouldn't share cash, burn, runway with them, because they have those could be used against you, right? By nature, an investor does not have an incentive to invest in your business, because they can just see how you progress without their capital, right? So they have an incentive to kind of drag their feet in a way. And so I would say not sharing those is what I would probably recommend. I think the goal of an update to potential investor is to provide like the sizzle, right? Like get them excited, build a relationship. Then, you pick that up in person or through Zoom or whatever the medium is, but it's to get them excited and to build a relationship. It's not to try to get them to invest through that update. For current investors, I'm trying to think of things I would not share. I think, the first thing that comes to mind is like some sort of weird thing happening with like the team or coworkers. I actually don't know off the top of my head. I'm gonna have to think about that. That's a good question of things like, what should you not share? My immediate reaction is, I can't think of anything, but I'm sure there is something you wouldn't want to share with an investor. What do you think, Marie? I'm kind of stuck on that one.
Yeah, I think to a great extent, what you mentioned, if there are issues with the team, unless it's with the founding team, within the founding team, then like it could be a big issue. Generally speaking, I think you should be very transparent with your investors. They're already your partners, so in a way, they should be part of the solution. Like you said, they're looking to add value. So if you're keeping issues away from them, maybe you're not allowing them to add value or to help you solve the problem. I think maybe the difference might be in the way you communicate it. So some things, when you put them in writing, they sound much bigger than they actually are. But if you pick up the phone and speak to them, or go see them, or have a coffee with them, maybe it's a much better way to communicate an issue that you're having with the business that you wouldn't necessarily want to put as a metric or as part of your report. That's what I think. That's for current investors. And with potential investors, like you said, they're investing in the future. They want to see what you've built so far and how this translates into the KPIs you have going forward and how you're going to achieve the milestones that you are saying you can achieve. So that's my take on it.
Yeah. Awesome.
Great. I think we have a few more minutes.
Yeah.
So we had a question about, so a lot of people are asking about raising money during COVID-19. So a lot of the founders are skeptical. They think it's not time to raise money. And so they actually stop reporting or stop generating monthly updates to their potential list of investors or existing investors. So what's your take on that? Raising money?
Yeah, I would say, I'll try to break this down in a couple of parts. And I think, and again, we love your thoughts. If you don't have to raise money right now, then don't. I think, because if you think what's happening, there's a lot of companies that need to raise money because, hey, this has changed, I'm burning cash, what have you. And so if you don't need to raise money, then don't, because right now there is such a demand for capital, and the market's taking a downturn that you're likely to get unfavorable terms right now, right? I think investors will try to use this time to get more ownership or lower valuation, what have you. So I would say if you don't have to raise money right now, then don't, and you'll be in a strong position. If you do have to raise money right now, then I would say it's, why are you raising that money, and being very transparent as to why. But regardless of the path you choose, regular updates are still key. But and again, the content might be different between potential investors and current, but I would still provide an update right now, especially to current investors. And here's why. So right now we're going through this crisis that is, the word unprecedented keeps coming up, but that's really what it is. And so an investor is going to want to see, how do you react in a time of crisis, and how do you communicate in that time? Because chances are this might happen again. This could happen again in the fall, right? Or maybe next year or in 5 years. But the point is, an investor wants to see how you react in a time of crisis and how you communicate with your team and current investor group. Because for the last 10 years or so, we haven't had a crisis. And so this is a first-time exercise for a lot of founders. An investor wants to see how you react to that. So certainly don't stop reporting just because we're in a crisis. And then for your current ones, or sorry, let's just say you are fundraising, I think some sort of weekly update to all of those potential investors is crucial. What are you changing? How is your business changing? How are you adapting to the current environment? And so showing momentum is key, and progress is key right now. And so I would say, even thinking about how do I become more frequent with my communication. Again, doesn't need to be long-winded, just like, hey, here's what's going on, here's what we did this week. We changed this for COVID. So I think it's even more frequent communication if you are fundraising, but don't feel like you have to fundraise right now if you don't have to, because everyone's fundraising. Investors are saying they're open for business. I'm not sure if that's true or not. I think we'll find out in a couple months if that's true. So long-winded way of saying, don't raise if you have to, still update investors.
Yeah, absolutely agreed. I think if you're a VC that has you still have time in your investment period and you have funds, you will need to invest. So
yep.
it comes down to the founders who will be able to show how their business is dealing with the crisis, how are they reacting, like you mentioned, and how they plan to come out as a strong business after this is over. And in fact, it could be an opportunity for investors to get startups at a slightly lower valuation. Well, it's a fact. What's happening. But at the end of the day, if this money is crucial for your business to keep going and to be ready for when this is over, then you might need to take a bit of a discount on valuation and get the money and keep working. So I do think that if you need to raise money, definitely continue to try and raise money and continue to communicate efficiently with investors. So we have a question from an investor perspective. So it's from an investor. How can I motivate my startups to communicate impactfully?
Yeah, I think there's a lot of So there's the carrot and the stick from the investor perspective, right? So the carrot is, signaling to your companies, hey, I'm more likely to invest in your company if I'm getting, communication. Maybe it's setting up office hours on a regular basis, or some level, or something that they get in exchange. But that the idea is signaling or marketing or messaging to the companies. This only takes a couple times, or this only takes a couple minutes a month for you to do, and it's really for the benefit of you as a company, right? It's not for me as an investor. It's really a benefit for you as a company first and foremost. And so really messaging that. And then in terms of the stick, I think there's certain things, you can see where in the term sheet or in the investment, you can say, hey, I'm going to get an update from you every month or every quarter. It's going to be part of my investor rights agreement. And so that is, or information rights rather. And so that's the other way. I don't know if anyone's ever, I don't know what recourse you would have if the company didn't do it. But I think there's a couple different ways you can incentivize a company to provide regular updates. But the first is like, this is really benefit for you first and foremost.
Great. We also had an interesting question that came through earlier. What is the most effective virtual elevator pitch? So you're pitching virtually, and you want to do like the most efficient elevator pitch.
Oh man, that's a good question. I'm not sure. I haven't had to pitch virtually yet, or at least for funding. I did read something online yesterday about companies using like Loom or Zoom and doing like a pre-recorded video that's personalized to the investor. So I record like a quick video of my pitch, and then I'm just sending that in an email along. So it's kind of like a quick pitch. Here's about my business. And using that as like the little carrot or sizzle that you can get the investor interested in. So I think it's keeping it concise. Again, concise is key. And then making it a little bit unique. Like, how can I stand out? And so that could be, I'm not sure if you're familiar with Loom, but you can record a video and put your face like as a circle and maybe walking through like 2 things that you're doing in your business virtually. So that's my initial thought. I'm curious, like, how are you guys coaching Flat6Labs companies at this time? Like, sounds like demo day is going to be virtual. How are you thinking about that?
So like you said, like you need to first highlight how your business is dealing with the current situation. You might be a business that is benefiting, or you might be a business that is hurt. And in both, you have to highlight how you're coping with the pressure. It's a pressure both ways. And just be honest and be clear on your strategy. Present the different scenarios that you have built for the business. Just show that you're on top of the game. I mean, as much as possible, obviously, and you're trying to build different scenarios for how things will develop over the course of the next couple of quarters, probably. So this is, it's been efficient so far, and we've actually had some startups that raised money post COVID-19, so it was very exciting, actually.
That's awesome.
Yeah, I believe we still have time for one more question, if I'm not mistaken. So I had a question, maybe it would be the last one, about burn rate. We talk about it like it's something bad or scared, but sometimes it is, it might be a high burn rate, but it's being spent in the right way and it's supporting the. So what are your thoughts on that?
Yeah, I mean, burn rate for the most part, and that's the reason venture capital and startups exist, right? It is, we are trying to grow as fast as we can and capture some percentage of market with something new and different. And so that's why capital exists, is because you need to burn capital to do that. So burn rate is not a bad thing inherently. And there's, and work with Flat6, my guess is like work with Flat6Labs and check it online, but there's a ton of benchmarks and resources that you can understand, like what is an appropriate burn rate. So if I'm spending $10 to acquire a customer, is that good or bad? Well, it probably depends on product, market stage, all of that, but burn rate's not a bad thing. I think the reason people are concerned about burn right now is we don't know how long COVID will last, and we don't know how future funding, traditionally I burn capital, I get to a milestone, and then I'll go raise more capital to get to another milestone. well, we don't know if capital is going to exist in the next milestone. So that's why burn's important. And we don't know how long, the top of funnel, like you driving new customers, is going to last. And so I think just burn rate's a little bit more crucial now, just because there's too many unknowns for future rounds of financing, and both from like financing from your own customers, right? Like, will my pipeline evaporate of customers, both consumer and B2B? And then will there be investors willing to invest in future rounds of financing? So I think, yes, burning capital is not a bad thing. It's how you finance growth. But right now it's a bad thing just because there's so many unknowns.
Amazing. I think our time's up. Thank you so much, Mike. This has been extremely useful. And over to you, Sarah.
Thank you so much for both of you. I want to invite everyone for next week's webinar from our Tunis office. And I also want to invite everyone for the Flat6Labs Bahrain demo day. It's the first digital demo day that Flat6Labs hosts. So I hope all of you can make it at 8 p.m. Bahrain time or 5 p.m. GMT. And good night and Ramadan Kareem to everyone.
Thank you so much. Hope you all enjoyed it.
Thanks, everyone. It was a pleasure.
Thanks a lot.
Take care.
Bye-bye. Good night. Good morning and good night.